Chewy is an online pet retailer with operations primarily in the United States that's expanding slightly or cautiously into Canada. The company does source some of its products from China, so it's not completely immune from these rising tariffs. Still, I understand investors are interested in this business during this current stock market volatile period. So I'm going to evaluate Chewy stock and answer whether or not I think the stock is a buy, hold, or a sell at current valuations.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at Chewy's revenue growth over the previous several years, it's done an excellent job in gaining market share in this industry. At 11.9 billion in trailing 12-month revenue, that's significantly higher than the roughly 3.5 billion it generated in 2019. Of course, the business boomed during the pandemic as in-person shopping was restricted and people preferred shopping online. What's more, Chewy offers its online customers a subscription service where people can subscribe to their pet food or pet medication or whatever needs their pets might have without having to continuously make these purchases over and over again. So it's a convenience advantage, and over 70% of its sales come from this subscribe as a service type of offering. That also allows Chewy to manage its business more effectively. If you have a better idea of when your customers need their products and where they need their products, you can manage your inventory more efficiently, lowering your cost to serve. You might say, why would any customer go with Chewy instead of Amazon for its pet service needs? Well, Chewy offers a more personalized service to pet parents that might like the fact that Chewy is a pet only company, whereas Amazon is more of a broad market business. So it has that kind of niche category offering, and it does unique things like send pet parents letters when their pet goes through significant events. I've heard of stories where Chewy will send a letter to pet parents that may experience a loss, and that increases loyalty that personalized service does with Chewy and its subscribers. Now, one of the reasons why I've liked this company over the previous several years is how effective management has been in boosting profitability and lowering the cost to serve. Its newer generation they warehouses that automate its facilities are getting better and better. The company is learning how to serve customers and lowering those costs. And you can see the cash flow from operations to sales with consistent improvements, even though there's been unprecedented circumstances within the previous 5 or 6 years. At a 5% CFO to sales ratio, it's not very high right now, but I like the trend line of improvement, and I like the moves the company is making to continue improving these margins. And I wouldn't be surprised if these go into the double digits over the next 5 years. Return on investor capital at 92% is remarkable, but I don't think it's sustainable. And I don't think there's enough data for investors to feel comfortable that this is the return on invested capital that Chewy can generate. These measures are volatile, especially in a short period. Chewy does operate a capital intensive business model. It does handle fulfillment, logistics, shipping, and handling. And so a return on investor capital of this level for a business with these kinds of operations is unlikely to persist at these levels. So investors can take notice of this very high level, but with little confidence because we don't have enough data on this company being able to deliver this kind of performance. Still, from what I've seen from management, I think the company will do relatively well in this metric. They've been good at allocating capital effectively. They haven't been wasteful. It's a very prudent management team. And so I can feel reasonably confident in this management team in their ability to steward investor capital. Now, I also did a discounted cash flow valuation for Chewy's business, and I found its intrinsic value per share to be worth $59. That's what I feel a fair value of this business is today. But you can buy this business right now for just $34. So I feel that this is significantly undervalued. What's more, this company has a market cap of 14 billion, over 14 billion, with zero debt and about 694 million in non-operating assets. So its balance sheet is absolutely pristine. It's already generating positive free cash flow. The expectations are for 510 million in free cash flow for 2025, which is forecast to rise to over $1 billion by 2029. Remember, the pet industry generates over $100 billion in annual sales in the United States alone, and Chewy is expanding into Canada as well. Moreover, when I look at its valuation on a forward price to earnings basis at 23, the stock looks relatively inexpensive given its prospects, given its growth, given the operating margin expansion and cash flow from operations expansion. So whether I look at the business on a forward price to earnings basis or when I look at it on a discounted cash flow basis, the stock looks undervalued. Still, the stock faces increasing risks during these uncertain times. Number one, Chewy does source a meaningful percentage of its products from China, which is exposed to a 145% tariff. Now, the company can switch that sourcing to other vendors, and it does have a vast local supply chain network in the United States for most of its product, including pet food, which is the most important category. The category where Chewy is sourcing from China are things that are not necessities or the more cyclical part of its product offering, like pet toys, uh, beds for your pets, etc., things like that. So it can outsource those things to other regions. It doesn't have to source from China, but the cost of those things will rise meaningfully as well. Also, if the United States goes into a recession, which is becoming more likely, Chewy's business could take a hit. Now, people will still buy food for their pets, but the more discretionary purchases could be cut back significantly. So it does face near-term pressure. All that being said, longer term, if I was to rate this business, buy, hold, or sell for investor that's thinking about long-term investing, 5 years or longer, I would say this stock is a buy. It makes a reasonable investment versus the risk versus reward for long-term investors. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.